Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Tuesday's Stock Play of the Day, we talked about Deere & Company. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at Deere & Company, good old John Deere. We talked specifically about a long call option, using a longer term option contract that was a little deep in the money. We talked about it as a fear of missing out trade. Basically, we have an infrastructure bill that is being discussed in the House. It's a good chance that something is going to happen in this space. We wanted to look at some stocks that may benefit from the passing of the infrastructure bill. So we went a little bit in the money, a little bit further out in time, and we bought a long call, which we are highlighting here inside the Options Playbook website. So let's see what happened with John Deere since Tuesday. What I'm showing you here is a 15-minute, 5-day chart on John Deere. We always tape Stock Play of the Day on Tuesday at noon Eastern time. So we're using live markets when we're looking at a paper trade in this underlying stock. So here's Tuesday and here's noon Eastern time. It's 15-minute bars. So here's from Tuesday at noon all the way up to Wednesday, all the way up to Thursday, and here we are on Friday. So right now the stock is a little bit down on the day. We're trading at 379.16, which means from the point that we put on the trade, this red line is showing you when the price that we were looking at when we talked about the potential paper trade. And that's around 365.40, I think, is where the underlying stock was at. So we're up just under 4%. I think it's about 3.8% since Tuesday on the underlying stock. So obviously buying a long call option is a bullish trade. So overall, this trade has done well. So there's not too much to talk about today, but I will give you a potential alternative. And we've talked about this trade more than once, where if you have a little bit of upside on a longer term long call option, what can you do? You can actually turn it into what's called the fig leaf inside the options playbook. We're going to sell a shorter term call against it. Now, not saying that is in the plans overall. I'm just giving you an alternative. So far, the stock is doing what we'd like it to do. We went out longer term on purpose overall. So you can make that decision going forward. So let's go back and look at the actual trade, our long call in John Deere. Oh, I also wanted to highlight before I go there, I got a little bit ahead of myself. This is actually a 1-year chart in John Deere, and we've obviously made a real strong move, and that move goes all the way out until about April, and then we started to get some chop. We hit an all-time high in May, and the markets have been fairly choppy since then. This is my line that I drew on our 5-day chart, so that's about where the underlying stock was at. And I just wanted to highlight that there's some resistance level right around here, right around the 380, I'm going to call it 387 level, if you look at my crosshairs. And it just looks like we've had a few touches right in here. We did break through and set that high, but we came down precipitously after that high was set. But there's quite a few little areas. So this seems to be a resistance area. So if you're thinking about selling a call option, I would just keep that in mind. If I got up towards that level is when I might think about selling that call option. I don't know if I necessarily want to do it today, but I would consider selling something right around the 386 to 387 level if I was going to sell a short-term call against that position. So now let's get into what the trade was that we talked about on Tuesday. John Deere right now is down about a 0.25%, down 94 cents on the day. We see our Ally Invest option chains. We did the January 2022 expiration. That's January 21st, 2022. 147 days still remain in that option contract. Went a little bit deeper in the money. We bought the 340 strike call. The delta's right around 47. When we did the trade, we saw the underlying stock was trading, or our trade was our option contract was trading around 47.40. Okay, so that was approximately the midpoint. You can't guarantee a midpoint fill, but it was somewhere right within that range. That meant we have $4,740 plus commission at risk on that trade. Right now, if we sold our long option contract, we're looking at getting about $50, and let's at the midpoint, we could even just say $50. That'll make the math simple overall. So you're looking at about $2.60 on that trade right now that you are up. So you're up approximately what you would have been on the underlying stock, but without all the underlying risk, right? So we build this as if you would have bought 100 shares of stock. This is what your cash outlay would be, as opposed to buying that 100 shares of stock. We're going to take a position and we're going to basically rent the stock going out till January. We're going to buy one call option. If you were going to buy 100 shares, one call option represents 100 shares. And we're going to use that option contract to minimize our risk going out till January, but still give us some upside potential. So the fact that we can see that we're getting a fairly decent movement, right? We don't own the stock, but we're getting that same type of percentage upside on our capital overall, is kind of highlighting the fact that, yeah, we're accomplishing our goal here. So this market is up a little bit. It's actually came down since the open, but we're now trading at 50.20 on our call option. What's an alternative? Well, I highlighted if we got a few more points to the upside, where I might think about selling a call option, but we'd be selling a shorter term option against it. Inside the options playbook, that strategy is actually called the fig leaf. You can feel free to check that out at a later date. But let's talk about selling that shorter term call option in it. One of the nice things about John Deere is that it's a fairly expensive underlying. We talked about that. On Tuesday's stock play of the day. And that inflates option prices. The more expensive the underlying, the more expensive the options will be in general. So we can get a fairly decent amount of juice by just selling a out of the money call option on the shorter term option contracts. So the September 3rd expiration is only 7 days away. We talked about the 387 level. Well, I don't want to sell anything in that area because I don't want to get called away on this. So we could look at the 390 level. Now, 390 means that we're bringing in $1.13 on the bid, $1.43 on the ask. Maybe we get $1.20 for it if we can work that order a little bit. Once again, not guaranteed a midpoint fill, but I don't need that much premium. Why? Because I didn't actually buy the 100 shares of stock. So if I'm bringing in just a little bit of premium, I'll be okay with that because I only have $4,740 at risk here. And on a percentage basis, I just want to kind of chip away at the amount of time premium that I bought in that option contract. So I'm going to actually go up and strike. I would go to the 395 level and I would look to sell that option contract. And that would kind of be the area I would target, 395, 400, depending on where that stock is at and depending on when you would sell that call option against your position. And I should say when or if you sell a call option against the position. But right now we can get a solid amount of premium. Right now we get 60 cents on the bid, 68 cents is the midpoint on this option contract. And if we did this and we sold this position against it for the next 7 days, we just want the underlying market to stay below 395. And if it goes up above, oh, well, we did pretty good on our call option in general. If that makes another strong move to the upside, as John Deere has done just recently. Now, if that does happen, you're going to want to adjust your position. You don't own the stock. That's why we call it a fig leaf. So look at the managing your position. As a matter of fact, I'll just pull that up real quick, and then we'll call it a day. So if you go inside the options playbook, you can look at managing your positions. You want to look at rolling a covered call. This is a fig leaf, not a covered call, but the same concepts apply inside this little section of the options playbook. So if you want to see how to manage your call option to try to avoid an assignment as the underlying stock is approaching your strike price, this is a great little section to read. And that's going to be it for this edition of the Stock Play of the Day Overtime. please click subscribe and ring the bell, and we'll see you this Tuesday on the next stock play of the day. Thanks for coming, everyone.